Hello viewers, during some of the previous lectures, we have attempted to understand the way various important adjustments are treated while preparing final accounts of small farms. Continuing with the same, I would attempt to wrap this topic in today's session by considering few more adjustments. Let us start with adjustments relating to bad dates. Bad dates imply bad debtors. That means, the customers who were sold goods for credit and finally failed to pay the dues for whatsoever reasons. Every business more or less suffers some amount of loss on account of bad dates. It is an indirect loss to business firm. If bad dates occur during the accounting period, these are recorded then. Sometimes it may happen that some of the debtors go bad at the end of accounting period and hence remain unaccounted in books. Such bad debts are treated as adjustment. Let us understand this adjustment logically using an example. Suppose the closing balances of sundry debtors and bad debts accounts appearing in trial balance are rupees 5,62,500 and rupees 25,500 respectively. The information available regarding unrecorded bad debts is further bad debts amounted to rupees 12,500. If you see the trial balance, it would appear like this. On the trial balance, you can see the name of the account sundry debtors and related amount of 5,62,500 is shown in the debit amount column, and bad debts, the next item with the amount of 25,500 again in the same column. Additional information, point number 14, I hope you understand. Continuing with the previous 4 lectures where we have understood 13 adjustments. This is 14th in line. So, 14th point, further bad debts amounted to rupees 12,500. Let us first understand reading this information. The bad debts of rupees 25,500 given in trial balance represent the debtors that have already been considered bad during the year and have been written off as bad debts during the accounting period itself. This amount has already been deducted from the total debtors of the business. On the other hand, further bad debts of rupees 12,500 given outside the trial balance represent those bad debts which have been found to be bad at the end of the accounting period. These bad debts are not yet recorded and written off. It implies that neither these bad debts have been removed from the balance of debtors given in trial balance, nor these have been written off against profit. At this point of learning, you may have a doubt. What does the term written off mean? When expenses and losses are transferred to trading and profit and loss account at the end of accounting period, it is said that these have been written off. So, writing off of expenses and losses implies setting them off against the incomes and gains of the current year by transferring them to income statement. Now, let us understand this adjustment logically. As the bad debts of rupees 25,500 given in the trial balance and bad debts of rupees 12,500 given outside the trial balance represent loss to the firm on account of bad debtors during the year, these two put together shall appear on the debit side of profit or loss account. So, the debit effect of this adjustment is that this amount of rupees 12,500 is to be added in bad debts of rupees 25,500 given in trial balance while transferring it to profit or loss account. I hope you understand that bad debts represent indirect loss for business and hence appear on the debit side of profit or loss account. At this point, you shall have one doubt: what if there are no bad debts on trial balance? In such a case, you shall directly show the amount of rupees 12,500 on the debit side of profit or loss account. As far as credit effect of this adjustment is concerned, this amount of rupees 12,500 is to be deducted from the amount of debtors while exhibiting them on asset side of the balance sheet. This is so because though debtors equal to this amount have already gone bad, these have not yet been deducted from the balance of debtors of the firm shown on trial balance. So, the two effects of this adjustment can be summarized as: the debit effect is that the amount of bad debts shown outside the trial balance is to be reported on the debit side of profit or loss account, and the credit effect of this adjustment is that this additional bad debts are to be deducted from the amount of debtors while showing them on the balance sheet. Now, let us understand this adjustment technically. For the same, first have a look into related journal entry. The journal entry for this transaction will be bad debts account debit to sundry debtors account. The amount is 12,500, the additional bad debts, that is shown in the amount column. Now, let us understand this journal entry technically. As you know, bad debts are a loss for business and hence categorized as nominal accounts. These are governed by the rule debit all expenses and losses and credit all incomes and gains. So, bad debts account has been debited in journal entry to record the unrecorded bad debts. On the other hand, sundry debtors are personal accounts representing debit the receiver aspect of related rule, as these are customers receiving goods for credit from business. As the basic nature of sundry debtors is debit, these increases when debited and decreases when credited. As some amount of debtors is being considered as bad, total sundry debtors are to decrease. Hence, sundry debtors account has been credited in the journal entry. One important point needs your attention here. Though a particular customer or customers have been considered bad, this journal entry has been passed through sundry debtors account and not through the concerned individual or group of individuals account. This is so because for the ease of handling, all the individual debtors of the business firm are put together and are totaled as sundry debtors rather than being shown individually on trial balance. The final accounts of the firm will appear like this after giving due effect to this adjustment. As you can see, the bad debts of rupees 25,500 reported on trial balance has been shown on the debit side of profit or loss account in the internal column. Two bad debts rupees 25,500, and the bad debts of rupees 12,500 given outside the trial balance has been shown as an addition to it. You can see plus further bad debts 12,500 and sum total of this two, that is rupees 38,000 rupees, has been shown in the external amount column. Moving ahead, as you see your balance sheet, in the current assets category, what you can observe is sundry debtors of rupees 5,62,500 taken from trial balance has been shown in the internal column, and this additional bad debts of rupees 12,500, which is the current adjustment that we are discussing, has been deducted from this amount of 5,62,500, and remaining good debtors of rupees 5,50,000 has been shown in the outer column. I am sure you have understood the effect of additional bad debts in preparing the final accounts. This was in a situation when firms do not maintain provision for bad debts and write off bad debts directly through profit or loss account. Now, extending this, let us have an insight into the treatment of adjustment relating to bad debts when firms maintain a provision for bad debts altogether. This is what you call adjustments relating to bad debts and provision for bad debts. To cover the loss of doubtful debtors in future, firms create a provision for bad debts out of the profit. Recall that according to convention of conservatism, firms are required to make suitable provisions for all prospective losses. It is on that premise that provision for bad debts is maintained by the firm. This provision is created on the amount of remaining debtors at the end of accounting period. Generally, Based on experience, the firms carry a practice of maintaining a certain percentage of closing debtors as provision for bad debts, and this calls for an adjustment at the end of accounting period. Let us understand this adjustment logically by clubbing it with our previous adjustment on bad debts using an example. Extending the previous example, suppose the closing balances of sundry debtors, bad debts and provision for bad debts accounts appearing on trial balance are rupees 5,62,500, rupees 25,500 and rupees 32,000 respectively. The information available regarding unrecorded bad debts and provision for bad debts to be maintained is: 1. Further bad debts amounted to rupees 12,500, and 2. Maintain a provision for bad debts at the rate of 5% on debtors. This will appear on your trial balance like this. As you can see on the trial balance, sundry debtors are reported for rupees 5,62,500 on the debit amount column. Bad debts are reported to be rupees 25,500 on the debit amount column. This is same as of our previous adjustment number 14. And new item is provision for bad debts reported for 32,000 rupees on the credit amount column of your trial balance, because provisions have a credit balance. Below the trial balance, what you can observe is there are two pieces of additional informations, 14 and 15. 14 is the earlier one only, informing further bad debts of 12,500. 15th is the new one, which says maintain a provision for bad debts at the rate of 5% on debtors. Let us first understand reading this information. You have already understood the way information on bad debts given in and outside the trial balance is read. On the other hand, provision for bad debts of rupees 32,000 given in trial balance generally represents the brought forward amount of provision created at the end of previous accounting year. This amount of provision is available to write off the bad debts that might occur during current accounting year. Further, second piece of information outside the trial balance, that is point number 15, that implies that the firm wants to maintain a provision for bad debts at the rate of 5% on the closing good debtors for current year. Now, let us understand these two adjustments logically. As you understood previously, the bad debts of rupees 25,500 given in trial balance and bad debts of rupees 12,500 given outside the trial balance represent the loss to the firm on account of bad debtors during the year. These two put together shall appear on the debit side of profit or loss account. That was the previous adjustment. But as the firm is maintaining a provision for bad debts, this loss on account of bad debts will not be written off directly through profit or loss account. Instead, it will be written off through provision for bad debts account, that is our adjustment. So, this bad debt loss of rupees 38,000 will not appear on the debit side of profit or loss account. In place, it will be adjusted against the provision for bad debts. You also understood that the amount of further bad debts of rupees 12,500 is to be deducted from the amount of debtors while exhibiting them on the asset side of balance sheet. I hope you remember that this is so because the bad debtors equal to this amount have not yet been deducted from the balance of debtors of the firm shown on trial balance. Now, let us understand the adjustment relating to provision for bad debts logically. First, let us understand the role of provision for bad debts given in trial balance. Recall that initially we understood that provision for bad debts is created out of the profits of the previous year in order to cover the loss on account of future bad debts, that is during the current accounting year. So, this amount of provision for bad debts appearing on trial balance represents a part of unused profits of last year. This balance of provision for bad debts account along with additional required provision, if any, will be available to write off the bad debt losses of rupees 38,000 discussed in the light of adjustment number 14. Now, let us understand the treatment of adjustment number 15 relating to maintaining provision for bad debts. As this is the amount of provision to be created at the end of the year, and as provisions are created out of profits, the debit effect of this adjustment is that it will appear on the debit side of profit or loss account, thereby reducing the profit of the firm. In parallel to reducing the profit of the firm, a provision has been created. Hence, the credit effect of this adjustment is that the closing amount of created provision, that is the closing balance of provision for bad debts account, will appear on the liabilities and capital side of balance sheet under current liabilities. So, the two effects of this adjustments can be summarized as: the debit effect is that the amount of newly created provision is to be shown on the debit side of profit or loss account, and the credit effect is that the amount of provision is to be shown as a provision under current liabilities and provision on the liability side of the balance sheet. Now, let us understand these two adjustments technically. For the same, first have a look into related journal entries. The journal entries related with these transactions are, if you see the journal, you will find three journal entries. The first entry is bad debts account debit to sundry debtors account, whereas the second entry is provision for bad debts account debit to bad debts account, and the last entry is profit or loss account debit to provision for bad debts account. Now, let us understand these journal entries technically. As far as first entry is concerned, I am sure you are clear with the same in the light of previous adjustment number 14 discussed separately. Let us understand second entry. Recall that provision for bad debts account is meant for setting of the losses on account of bad debts. So, provision for bad debts account has been debited to utilize the amount of provision against bad debt losses of 38,000, that is 25,500 and 12,500. Further, as through this entry we are writing off the bad debt loss against provision, bad debts account has been credited and written off against the provision through the entry. It implies that now bad debts will not appear separately in profit or loss account, as these have been already written off against provision for bad debts. We also understood the same logically. Now, let us understand the third entry. As creation of reserves and provision is done out of profit and reduces the total profit, profit or loss account has been debited in the journal entry. I hope you understand that when profit or loss account is debited, it implies decrease in profit. Further, reserves and provisions created out of profit represent a part of profit separated for general or specific purposes. Hence, provision for bad debts account is credited, representing part of profit on the lines of rules for nominal account, that is, credit all incomes and gains. One important observation that might have sought your attention here is the amount of provision created, that is rupees 33,500. Let me explain you the same. Understand that a provision for bad debts is created against good debtors, that is those debtors which have not been considered bad yet. Note that the balance of sundry debtors account given on trial balance is rupees 5,62,500. Further, according to additional information number 14, further bad debts amounted to rupees 12,500. Relating these two information pieces, understand that out of the closing balance of sundry debtors of rupees 5,62,500 given in trial balance, rupees 12,500 have gone bad. I hope you remember that as the bad debts of 12,500 rupees are given as additional information, the same has not yet been deducted from the amount of debtors given on trial balance. It means that the amount of good debtors at the end of accounting period is rupees 5,50,000. That is, rupees 5,62,500 minus rupees 12,500. So, provision for bad debts required to be maintained is 5% of this amount, that is 5,50,000 rupees. So, our provision will be 5,50,000 rupees into 5 by 100, that is rupees 27,500. Further understand that as provision of rupees 27,500 is to be maintained on closing debtors, it implies that the closing balance of provision for bad debts account shall be rupees 27,500. Putting all this information together, it can be understood that the new provision to be created during the current year is rupees 33,500. The same has been calculated as bad debts to be written off during the current year is rupees 38,000, you know, two bad debts 25,500 plus 12,500. So, we have to write off bad debts of rupees 38,000 during the year, and then the new provision to be created as we calculated right now is 27,500 rupees, that is 5% of 5,50,000. That makes a total provision requirement of 65,500 rupees. Out of this total requirement of rupees 65,500 rupees of provision, you observe that 32,000 rupees of provision is already available with you, which is reported on the trial balance given to you. So, out of 65,500 rupees 32,000 has been deducted as it is already available, and that is why the new provision to be created is 33,500 rupees. To be clearer on this, let us prepare provision for bad debts account on the basis of trial balance and related 3 journal entries passed in the light of these adjustments. I am sure you are clear with the process of ledger posting learnt during classifying stage of double entry system. Once you have done the ledger postings of these journal entries as relating to provision for bad debts account, your ledger account will appear as you see your provision for bad debts account. On the debit side, there is posting 2 bad debts rupees 38,000 rupees, which is result of second journal entry, and there is posting on the credit side which says by profit or loss account 33,500 rupees. Apart from this, opening balance of 32,000 which is taken from trial balance is also reported on the credit side. Now, if you remember, we calculated the provision to be 27,500 at the end of the year. So, this shall be your closing balance. That is why this is reported on the debit side of provision for bad debts account as to balance carried down 27,500. It implies that the 33,500 rupees of profit or loss account representing new provision is a balancing figure which is resulted out of your calculations that I have discussed with you just before this posting. Once you have given due effect to this adjustment as well, your final accounts will appear like this. As you see, profit or loss account, this provision created by you, that is 33,500 rupees, is reported on the debit side of profit or loss account, showing creation of new provision out of profit. Recall, I told you that once we write the bad debts out of the provision, the bad debts will not appear on profit or loss account directly as they have been absorbed by provision account. Moving ahead, as you go to your balance sheet, what you can observe is on the asset side, sundry debtors of 5,62,500 as reduced for additional bad debts of 12,500 has been reported to be rupees 5,50,000 rupees in the amount column. And as you see the liabilities and capital side, what you can find is provision for bad debts account for rupees 27,500. I hope you understand that rupees 27,500 is the closing balance of provision for bad debts account. The same has been reflected on the balance sheet of the firm and will be carried forward to next year for the same process. I am sure you have properly understood these two adjustments put together. With this, we come to a conclusion of today's session. Before we close the session, let us summarize our learnings from today's session. 1. Bad dates given as additional information represent those bad dates which have not yet been recorded and written off. It implies that these bad dates have not been yet removed from the balance of debtors given on trial balance and hence are required to be deducted from debtors given in trial balance. 2. Provision for bad debts given in trial balance generally represents the brought forward amount of provision created at the end of previous accounting year. It is available to write off the bad debts that might occur during the current accounting year. And 3. Provision for bad debts is maintained on the amount of closing good debtors, that is, the amount of sundry debtors given in trial balance as reduced for the amount of additional bad debts, if any, given outside the trial balance. One important point I wish to mention here. Though before initiating first session on adjustments in final accounts, we learned that ledger accounts are closed before preparing final accounts. For the purpose of giving due effects to various adjustments, it has been assumed that ledger accounts are still open and amenable for the purpose of passing adjustment entries. Accordingly, all the adjustment entries have been passed using the affected accounts only and not using the final accounts. Understand here that if ledger accounts were finally closed, all the adjustment entries would have been passed using final accounts and not the affected accounts. Further, I have not discussed closing entries at any point of this module on financial accounting. This has been thoughtfully done keeping in mind the level of learning required for the targeted audience. By this we come to conclusion of our today's session. In our next session, we would exemplify our learning on preparation of final accounts with adjustments. Till then, have a great learning. Thank you.